Hi everybody, today I'm going to share with you 3 Singapore stocks that are good for retirement. The first stock I'm going to talk about is called ST Engineering, which is a company that headquarters is based in Singapore and have operations across Asia, Europe, Middle East, and the US. ST Engineering was formed in 1967 and listed in 1997. It had more than 25,000 staff globally. The company is mainly divided into 3 major business segments, which is called the commercial aerospace, we call the CA, the urban solution and the STATCOM, which is called the USS, and the defense and public security, which is called the DPS. Among these 3 business segments is further subdivided into 9 sub-segments, as you can see from the chart here. Let's look at ST Engineering financial performance for FY 2021. For 2021, we can see that the DPS is the major contributor to the group, which contributes 53%, followed by the CA, which is the commercial aerospace, contributes 32%. And the USS is about 15%. The main contributor is mainly from Asia, which contributes about 58%, followed by US, Europe, and others. What I like about the business segment of ST Engineering is that it is more weatherproof in a certain extent, where you can see that during the COVID period, the commercial aerospace revenue have dropped due to COVID as we can't travel. And it started to pick up for FY 2021. Despite that, the business on the defense side, the revenue have been growing year on year, whether there's COVID or there's no COVID. And this will give the group stability in our total revenue during the tough time, which is FY 2020, that is a COVID period. And let's look at their first quarter FY 2022 result, which have a gross revenue of 2 billion. Is a 13% growth from first quarter 2021. This 2 billion is equivalent to the first quarter 2020 result, which is a pre-COVID level. In short, ST Engineering had managed to get their revenue recovered to the pre-COVID level already. And let's look at their first quarter 2022 revenue breakdown. The defense contributes more than 50% of the total revenue, followed by the commercial aerospace and followed by the urban solution and STATCOM. And do take note that the commercial aerospace have not recovered to the pre-COVID level yet. And thus going forward for the next few quarters, we expect the performance of commercial aerospace to further improve. This may indirectly mean that the group revenue will be better than the pre-COVID level revenues. For the first quarter 2022, they have secured $2.4 billion of new contracts. With that, their total order books is $21.3 billion, which is a record order book for them. And $5.8 billion of the order book were able to deliver in the remaining months of 2022. This actually shows us that there is visibility for ST Engineering, not only for the next few quarters, it also means for the next financial years also. Let's look at the 5-year financial statement for ST Engineering. From FY 2017 to 2021, we can see that the FY 2021 revenue is very close to the pre-COVID level already. And we expect that for FY 2022, it should be able to surpass the pre-COVID level revenues. And also the earning per shares is also reaching the pre-COVID level. And we expect that with the first quarter performance for FY 2022, for the next few quarters, ST Engineering will be able to continue to deliver good results. And their return on equity is around 20%, which is a very respectable return on equity for company of that size and business of this nature. One thing that's not so ideal for ST Engineering is the dividend have been rather stagnant for more than 7 or 8 years. They have been paying 50-cent dividends since after the global financial crisis. And the dividend payout ratio is on the higher side, which is average about 90%. Despite the high payout ratios, ST Engineering was still able to continue to grow through acquisitions of companies. This is a chart to show ST Engineering performance compared to STI pre-COVID to current situation. And we can see that ST Engineering is still down 3.91% compared to the pre-COVID level share price, while STI is down about 2%. So ST Engineering is slightly underperformed the STI during this period. Okay, however, when we look at the longer term perspective, we can see that since STI IPO until to date, they have delivered a 200% returns in price compared to STI, which only delivered about 105%. So ST Engineering have given a return that's double what STI have given since 1997 to today. Let's look at their defense and public security side. There's a segment called the Digital System and Cyber segment, where they will do cloud, software and artificial intelligence and cyber. And this is the digital business that ST Engineering is focusing to grow. Then they plan to grow this revenue to 500 million by 2026. Currently, the revenue is about 250 million. That means they plan to double the revenue for this digital business by FY 2026. And currently, this digital business revenue contributes slightly less than 20% to the whole digital system and cyber business segment. And with the current political and market situation, there is a big demand for digital business, and their customer segment will definitely include the defense and the government's critical infrastructure and also the enterprise. That means there is actually a pool of potential client for ST Engineering to acquire or to do business with for their digital business. On top of that, ST Engineering still continue to grow by continue to acquire company. Then also they go and buy over new tech. The recent purchase in last year is they bought over TransCore so that they have access to the North American market. With global event that's happening now, where we got the COVID-19 situation and the Ukraine and Russia conflict that have resulted in oil price going up, energy price going up, labor shortage, supply chain risk, and all these things. And all this have actually affect many companies in the market. However, for ST Engineering, they mentioned that with the current global event happening, there is not material at the group level. This shows how weatherproof this company is, which is why I feel that this company is a good dividend stocks for retirement. On top of that, this is another piece of good news for retail investors. ST Engineering have finally decided to increase their dividend from 15 cents to 16 cents for FY 2022. So finally, we have seen a dividend increase for this company. On top of that, they're going to pay this dividend 4 times a year instead of twice a year. For investors, you have the dividend payout more frequent, and you'll be 4 cents per payout. And I hope that going forward, ST Engineering may be able to further increase their dividend in the foreseeable future. The second dividend stocks that I'm going to talk about is called SGX, which is a known stranger to investors out there. It is the Singapore exchange. However, do think that SGX business doesn't really mean equity trading in the Singapore markets. And SGX has transformed over the years. Today, actually, SGX Group have offered customers broad and deeper propositions for them. On top of the normal security tradings, they also have equity derivatives, they have commodities, they have even create their own indices, and they also have the fixed income and the forex side of business. How they are able to do that is they have acquired company along the way so that they can offer customer more solution. The main key business of SGX will mainly divide into 3 parts. Okay, one is the equity, which include equity derivative, not only purely just buying and selling of shares. It include leveraging investment, and that will form the core of SGX business. We contribute about 66%, followed by the growth with the FYCC, the fixed income, currency and commodity, and followed by the emerging one, which is called the data connectivity and indices, where SGX actually have created several of their own indices. For example, you may have heard of the IH index, which is actually created by SGX. Let's look at the first half FY 2022 result compared to first half of FY 2021. The result is not really fantastic. Actually, the revenue is just comparable. If you were to include the treasury income, it is just comparable. That means practically it's just flat, and the expenses have go up, and this would resulted in their impact have come down. So this is the revenue breakdown. We have seen that the FICC and the equity derivative have increased, okay, but the equity cash have dropped and the DCI have go up. Their treasury income have down due to lower yield, due to lower interest rate. We may see this reversing in the next 6 to 9 months due to increasing interest rate. This is the show of the treasury income that the decline has started to slow down from first half FY 2021 to our first half FY 2022. With the interest rate rising, the treasury income will be able to pick up in the next 3 to 4 quarters. And this will have a positive impact to the bottom line to SGX. How SGX have grown over time is through acquiring company, and SGX was a debt-free company, but they have started to slowly buy over company. However, they are very prudent using of their leverage, and currently their gross debt to EBITDA ratio actually is 1.4, which is actually very, very low for the company of their size. Let's look at their 5-year financial statement. Their operating revenue have been growing over the past 5 years, and they are actually not affected by the COVID. In fact, they actually benefit from the COVID. From here, you can see that actually their FY 2020 and FY 2021 revenue have been higher than the pre-COVID level revenues. One thing I like about SGX is when I look at their operating profit margin, it is more than 50%. And this shows that the company is a very high margin company. When you look at the net profit margin, it is more than 40%, where actually it's quite tough for you to find company of this size in the Singapore market that have a net profit margin of more than 40%, and the return on equity is more than 30%, which is considered very high, and you can actually consider this is a growth company. The dividend payout ratio actually have come down over the years from 80+% to come down to about 70%, and despite the payout ratio have come down, their dividend actually have increased, and that's a good thing for investor. Let's look at the price charts of SGX compared to STI. From this chart, we can see the SGX share price actually is higher than the pre-COVID level, but it have dropped more than 30% from the peak in last year, July or August. But nevertheless, they have still outperformed the STI by a 10% margin from the COVID level to current market condition. And let's look at long-term performance for SGX since the IPO. Since SGX IPO to date, STI have given you a return of 58%, but SGX have given you a return of 600% in terms of price returns. SGX will give you a return that's 10 times more than STI. And not much company listed in Singapore can give you a return that's 10 times more than STI over a long period of time. Let's look at the growth part of SGX. One thing to think of, SGX suite of China assets product allow investors to participate in the China market, be it on the equity side, be it on the currency side, commodity side, or even the fixed income side of the China renminbi market. However, there's also the risk, as this is a big contributor to the SGX revenue. So SGX start to diversify their risk, and they start to also expand their market beyond China. And they have also went to Thailand, they also went to India, and they also expanded their mutual offset system with the US, and they also have partnership with New Zealand on the derivative products. So SGX have been constantly growing and constantly and more present overseas. So it is not only an exchange that depend on the Singapore stock market trading activities. And this is the dividend payout history for SGX since the IPO to date. From IPO, that time they are issuing a dividend of 5.5 cents. And with the current first half dividend 16 cents, we can see last year is 32 cents. The dividends have increased by more than 5 times since the IPO to today. On top of that, SGX also pay dividend 4 times a year. And they also want to be a growing dividend company over time, which means that your dividend will be hedged against inflation if the company dividend grow over time. The last company I'm going to talk about is called Capitaland Invest. This is the old Capitaland without the property development side of business. It was relisted in last year, October 2021. Capitaland Invest mainly have 3 main forms of business. One is called the fund management business. The other one is called the lodging business. And the third one is called the capital recycling part of business. To put it very simply, is they buy and sell properties. Let's look at their first quarter 2022 result. Their fees income related business, which is the lodging business, the property management, and the fund management business, have increased by 17%, while their real estate investment business have increased by more than 28%. Do take note, we are actually looking at from COVID level to current level, and thus definitely they are recovering from that market downturn. And let's look at their real estate portfolio, where currently 33% of it are in Singapore and 32% of it are in China, and followed by the rest of the market. So out of Asia, currently it's only 15%, which I feel that there may be a good potential for them to grow further in the future. And by asset class, it is pretty well diversified, where they got 31% lodging business, 27% retail. New economy, which will be expected to be the growing one, will be currently at 15%, office at 18%, and others at 9%. So let's look at the fund management business, where they mainly have 2 parts. One is called the listed fund, where there is total 6 REITs under them. 5 of them are listed in Singapore, and 1 of them is listed in Malaysia. So this is what we call an open-ended fund, where they are sponsored for the 6 REITs, and the risk management fee will be actually escalated to Capitaland Invest. On top of listed fund, they also have private funds, and we expect their private fund to be also to continue to grow. So by growing on the fund management business on the private side and the listed side, this will increase their fees income over time. And lodging business, currently they have 135,000 units, where they are on track to achieve 160,000 units under management by 2023. For the capital recycling business, they have divested more than $1.6 billion worth of properties. For a company of this size, actually their gearing is very, very healthy, with a net debt to equity is only 0.48 times, and their interest cover ratio is 6.2 times, which is much higher than a lot of REITs actually listed in Singapore. Let's look at the price performance of this counter. Since they changed their stock code in October last year, you have up close to 30%, while compared to STI is only up 1.7%. And this has actually shown that this stock outperformed STI by a big margin. What about growth potential of this counter? Their return on equity currently is 8.7% for FY 2021, and they are targeting to achieve double-digit ROE, which personally I think that is achievable for them. As previously before COVID, before they take off the property development sector, Capitaland actually have managed to have a double-digit ROE also. Now without the property development side, double-digit ROE I think is definitely achievable for them in the near future. And they'll continue to grow their fund management business, their lodging business also, and of course their capital recycling will be ongoing. With the growing of fund management and lodging business, this will make Capitaland invest more towards the REIM, the real estate investment management company in the market. And how are they compared to those REIM now in the market? Capitaland price to NAV was 0.8 times. In general, all the Singapore property stocks, their price to NAV are constantly trading at the discount, because the market have factored in the uncertainty, the lumpy business of the property development side. So by removing the property development side of the Capitaland, now they call Capitaland Invest, their price to NAV currently is around 1.2 to 1.3 times based on the current market price. But compared to the REIM in the market, they are trading at 2.6 times price to NAV. And Capitaland Invest is moving towards the direction to be the REIMs, where they continue to grow their fund management business, their fee-based business, and thus long-term wise, their price to NAV is supposed to increase over time. Currently, their fee-based business is contributing only about 18%, and they plan to grow it to about 40%. And this will have a very good potential for the price to NAV of Capitaland Invest to increase. They have announced their dividend payout, which they pay out in May. They issue a special dividend of 3 cents plus a normal dividend of 12 cents. That means the dividend payout is 15 cents. So this is one thing I like about Capitaland. Before COVID, Capitaland is a dividend growing stock. That means their dividend have been slowly increasing over time from 8 cents, 9 cents, until before the COVID, the dividend is 12 cents. And when the COVID comes, their dividend have dropped to 9 cents. Because they have to cut their dividends, and now they are more like out of the wood already. The new Capitaland Invest, still managed by the same management team, have decided to give a special dividend of 3 cents, actually indirectly to pay back the dividend cut during the COVID period, so that to restore the dividend back to 12 cents. To me, this is a very positive move by the management, and not much company will do that to pay back the dividend they have cut during the COVID period. That's all I have to share with you today on these 3 Singapore dividend stocks for retirement. If you find that this video has benefited you, do remember to like, share, and leave your comment below. And also do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.